The balance sheet shows the financial position, assets, liabilities, stockholders' equity of a firm on a particular date, such as the end of a quarter or a year, right? So the balance sheet is as of 10/31/2015. And obviously on there you're going to find assets, liabilities, shareholders' equity. That's all you're going to see on there. We're not going to in-depth go through each one of these, okay? So I'm just kind of giving you all the warm welcome into these. Now we're going to hit an income statement, and that's going to show the result of operations, revenues, expenses, net profit and loss for an accounting period. Then I'm going to skip the next one, and we're going to go to the statement of cash flows. Now this provides information about the company's inflows and cash outflows from operating, financing, and investing. Years ago, this wasn't looked at as much as it should have been, because understand that in the old days, and I'm going back 20, 30 years ago, somebody would say, well, are we going to sell this company? And they would look at the income statement and say, well, we looked at the last 3 years and their sales have gone up by 5% a year, so that's good. And we look at the income statement and say, well, they've made money in every one of those 3 years. Then they might go over to the balance sheet, do a couple quick ratios, and go, hey, this is great, let's sell. However, they never looked to see if the company was generating cash. And if you can't generate cash, you could go bankrupt. And some of the typical stories for that were Grants and Woolworths way back when. And when you look at those financials, they were not generating cash from operations. And again, you can generate cash by borrowing, okay? But eventually you've still got to pay it back. And if you're not generating cash from what you're doing on a daily basis, you're in trouble. So those are the main three I'd look at. Now the other one, which is the statement of stockholders' equity, that really just reconciles the beginning and ending balances of all the accounts that appear in the stockholders' equity section of the balance sheet. So you can use that one every month, you know, as one of your close options to reconcile everything. But I'm not, I don't spend much time on that. All right. Another important piece are the notes to the financials. So immediately following the four statements is a section entitled Notes to the Financials. These notes are an integral part of the statements and must be read in order to understand the presentation on the face of each financial. The first note of the financial statements provides a summary of the firm's accounting policies. And if there were any changes of the accounting policies during the reporting period, these would have to be explained, as well as their impact on the financials. So let's take an easy one. Let's say a company was using the inventory method of Lifo. Okay, Lifo is last in, first out. So in a regular year, the product that you're buying in January, let's just say is $1. But by, let's say, October, the price goes up to $1.10. So if you're using Lifo, which is the one you probably should be using, that matches more current revenues and current expenses. So the stuff that's coming in at $1.10, and let's just say you're selling it at $1.50, you have that 40-cent margin on everything you sell. So for the year, you've been selling on Lifo, and then let's say, the new financial guy comes in and goes, oh, no, we got to switch to FIFO. So now he goes back and changes the method of accounting to FIFO. Now, all along, every sale you had was $1.50 less $1.10, and you were showing 40 cents profit on everything. Now he comes in and says it's FIFO. So now what happens is you're making 50 cents on everything versus 40. So just by changing that accounting method, you're going to show that you made more money. But in the real world, did you really make more money? I mean, what you want is quality earnings, and quality earnings are that you sold more widgets this year than last year. Okay, it's not having a price increase and say, hey, our sales went up because of a price increase or an accounting change method. So that's why you need to look at the notes to understand it. Okay, so some of the notes would pertain to other things such as inventory, property, plant, and equipment, and long-term debt. You want to find out what interest rate are they getting from the banks Because if the banks are charging them a high rate, they must think that there's some risk there. And if you want to extend them credit, but the bank is giving them, high risk stuff, that should be a flag for you also. Other things that would show up include major acquisitions or divestitures that took place, officer and employee retires, pension plans, a lawsuit. So let's just say this company has a union and the contract's going to come up, all right, and you want to put all your eggs in this basket because they have a great product, but there could be a union strike coming up this year. Well, knowing that, you may want to second source somebody else just in case that strike does happen. So again, that's why these notes are so important. The other important thing right off the bat is the auditor's report and opinions. After all their work's done, they issue the report. So this report related to the financial statement notes is the report of the independent auditor. Management has responsibility for the preparation of financials, including the notes. The auditor's report attests to the fairness of the presentation. Okay? So you're telling the auditors, here's how we run our business. They go back and test it. There's four basic opinions. The best one you could hope for if you've got audited financials is for them to have an unqualified opinion. And you're going to see one of these in our sample case. The unqualified opinion states that the financial statements present fairly in all material respects: the financial position, the results of operation, and the cash flows for the accounting period are in conformity with generally accepted accounting principles. If you can see that, that's a great start to look at this customer that you may be doing business with or making a loan to or anything. So unqualified. Next is a qualified. This is saying that there's a departure from generally accepted accounting principles will result in a qualified opinion. And the use of the language is going to say, in our opinion, except for, maybe they changed inventory methods or accounting methods, the financial statements fairly present. And understand that these are the exact words used in every opinion, okay? So qualified, depending on what it is, as well as unqualified are the two you want. Now, some of the ones to be nervous about: adverse. If departure from GAAP affects numerous accounts and financial statement relationships, then an adverse opinion is rendered. This states the financial statements have not been presented fairly in accordance with generally accepted accounting principles. A couple other ones are a disclaimer, okay? This might be lack of independence by the auditor. They just don't want to make an opinion at all. And then there's a limited scope, which basically says, look, we really couldn't get enough information from them. We couldn't do enough work to really give you an opinion. And then there's a couple others which, for sake of time, we'll pass. But the last thing on here is, in theory, the auditing firm performing the audit and issuing the report is independent of the firm being audited. However, keep in mind the auditor is hired by the firm whose financial statements are under review. These same auditors also used to do consulting and tax work for some firms. As I mentioned earlier, this was a huge conflict of interest.